Investing money is a fantastic method to build wealth, especially over time. However, if you're new to investing, it's simple to fall into certain traps that could cost you money. There are two forms of investment traps, cognitive and emotional, but they're generally termed behavioral biases. In most cases, a bias is an unconscious tendency to think or act in a certain manner in a given situation. Because investing constantly entails imprecise knowledge and a variety of probabilities, it's easy for investors to become caught up in them. There are numerous areas of investing over which we have no influence. Sure, we can aspire for a specific result, but we can never be guaranteed. As a result, biases are merely the shortcuts we employ when making financial decisions. Thus, in this video, we'll be looking at some of the traps you should look out for. And, before we begin, do subscribe if you're new and give this video a like for that YouTube algorithm. Now let's get into it. 1. Anchoring trap. Anchoring refers to an over-reliance on what one originally thought. It involves holding onto the idea of the initial value of an asset to an extent that causes a person to make wrong decisions. For example, you might be under the impression that a certain company is successful and think that buying stocks is a good way to. However, this concept may be inaccurate at present or at some point in the future. The same as seen when an investor holds onto a stock for too long, because they're anchoring on the higher price than the stock was purchased for. When in a real sense, the stock should have been sold a long time. To avoid falling into this trap, keep an open mind and be open to new sources of information. Also, keep in mind that just because a firm is doing well now doesn't imply it will continue to be so tomorrow. Some factors have been demonstrated to minimize anchoring, but even when people are made aware of the bias and try to prevent it, it's difficult to avoid it completely. In any case, keep in mind that just because a stock performed well in the past does not guarantee future performance. If you want to know how the asset will likely perform in the future, conduct some research and look into its price history. Be receptive to fresh investment information, even if it contradicts what you already know about the stock. Initially. 2. Sunk cost trap. This entails safeguarding previous mistakes or choices, which can be detrimental to your finances. This is caused by a refusal to admit that you made a poor decision that resulted in losses. It's also known as a person's proclivity to carry through with something that doesn't match their expectations, owing to the fact that they've already committed their time or money. This helps to explain why individuals keep things they don't wear, eat meals they don't like and watch movies they don't enjoy, and why they keep underperforming investments. This is similar to anchoring and involves investors holding on to stocks in the hopes that the price will return to where it was at the start. In this scenario, the investor is safeguarding their decision to acquire and keep that particular asset, which can have a detrimental impact on their portfolio. If your investment isn't performing well or is rapidly sinking, the best suggestion is to abandon ship as soon as possible and research for something more promising. Accept the loss or the reality that you made a terrible judgment, no matter how difficult it is. If your investment doesn't pan out, get out before the asset's value plummets even further. A word of caution: prevent developing emotional attachments to your investments in order to make it easier to unload them before they deteriorate further. The best way to avoid this trap is to define financial goals. Investors can set performance goals for their portfolios, and if they don't meet them, they can be re-evaluated to determine where adjustments can be made to boost returns. 3. Pseudo-certainty trap. The term, also known as loss aversion, is another phrase for an investor's attitude toward risk. When investors believe their investment returns will be positive, they reduce their risk exposure. When they're on the verge of losing, they'll reach out more and take more chances. They are willing to raise the stakes in order to regain capital, but not in order to create more. When the prospect of losing money outweighs the potential for profit from an investment, loss aversion may be present. It usually happens when an investor refuses to take risks. Of course, there is always risk in investing, and some are riskier than others, so as not to lose money. When you suffer from loss aversion, you miss out on opportunities to profit because you're afraid of losing your investing cash. Without a doubt, taking on too much risk, as well as not taking enough, is a recipe for disaster. Make a sound investment strategy and don't let emotions influence your choices. Allow yourself to become uneasy, and make educated selections about where to invest by selecting assets with a proven track record. 4. Superiority trap. Otherwise known as the overconfidence trap. Many investors are overconfident, believing that they know more than the professionals or perhaps the market itself. Even if you are well educated, you can profit from a few pointers now and again. Many investors have lost a lot of money by thinking they're better than everyone else, and these are usually the same folks who fall into numerous of the aforementioned investment traps. Investors that are stuck in a superior mindset have inflated self-esteem. They are overconfident in their investments and talents, and as a consequence, they may dismiss sound advice, which may lead to errors in their own judgment. As a result, the investor may become irresponsible and lose money, based on the idea that he or she knows more than the market. The investor believes that the market will eventually recognize the stock's value offer and drive it higher. If, on the other hand, the stock continues to fall, the investor decides to reduce his losses and close the investment. If you are overconfident in your investments, you may overlook the protections that are required to secure your investment capital. You may make poor decisions and take on too much risk, which may only lead to losses. 5. FOMO. This stands for fear of missing out, which is closely related to following the sheep's behavior. Because it encourages people to copy what others do rather than think about things thoroughly. The term, sheep mentality, refers to a person's predisposition to follow and mimic what other people are doing, in this case, other investors. Instead of their own independent thinking, they are mostly swayed by instinct and emotion. Instead of making their own informed decisions about where they'd like to invest, investors tend to follow other investors because they see them succeed. Those who fall into this trap usually fear missing out on a potentially lucrative investment when they see their friends or someone close to them investing heavily in it. As a result, rather than feeling excluded, they feel a lot happier and more at peace when they follow the herd. Many dot-com companies, for example, did not have a financially sound business model, yet many investors purchased them purely because others were. Following the herd appears to be a method by which investors believe they are making the best decisions. As a result, if everyone else is exiting the market, they feel safe doing so as well, rather than being the only ones left. Don't rush into doing what others are doing without first conducting your own investigation. Before selecting whether or not to invest, carefully consider the investment and the company's fundamentals. 6. Irrational exuberance. Irrational exuberance, also referred to as overconfidence bias, is the tendency to hold a false and misleading assessment of our skills and intellect. In a nutshell, it's the conviction that one is better than one is. While confidence is seen as a strength in many situations, it is seen as a drawback when it comes to investing. As though there is no uncertainty in the market, investors prefer to believe that the past equals the future. What happened previously will almost certainly happen again. There will always be ups and downs, something that will turn the tables on previously successful ventures. Investor overconfidence typically evolves into greed, pumping the market to the point where a massive fall is unavoidable. And those who went all in right before everything went wrong are the ones who are suffering the most. Those who are overconfident and believe the well will never run empty. If you're new to investing, consider working with someone who has done it before and can come up with a sensible investment strategy that maximizes rewards while minimizing risk. You don't have to rely on yourself because there are numerous specialists available to assist you. 7. Confirmation traps. A confirmation trap occurs when people look for and take notice of other investors or assets that confirm their current. It could also happen if investors keep getting advice from those who have made and continue to make the same mistakes as them. Sometimes people seek out counsel from these people who are hoping to make the proper option this time around. Rather than listening to someone who has given you lousy advice, seek out new sources who might provide you with excellent information on potential investment opportunities. When researching and investing, investors may unintentionally seek out or favor information that confirms their previous assumptions about the asset or strategy, while ignoring information that contradicts them. This leads to a one-sided perspective, which leads to poor investment judgments. Confirmation bias is a form of investor overconfidence that helps to explain why they don't always act rationally and may support assertions that the market is inefficient. Knowing that confirmation bias exists is the first step toward overcoming it. They should explore alternate viewpoints that challenge their perspective after acquiring evidence that supports their beliefs and opinions. In other words, they should keep an open mind. It's true that investing comes with risk, but you may be even more vulnerable if you find yourself caught in one of these investments. Do your own research beforehand and find out what works for you. Follow some of these tips and save yourself from losing not only your time but your money as well. And with that, thank you so much for watching. Have a great week and I'll see you all in the next one.